Hi there, welcome to Kneppy Invest and welcome to a standalone answer and reply video. This is from Yakito Riot Aku, who says or asks, can you please do a special video where you go through an annual report of a company in depth, start to finish sort of thing? Maybe TLX Pharmaceuticals. I bought the dip this morning and also during the recent dip like 2 weeks ago. Thanks. Now, I'm recording this video at 11 a.m. on Wednesday, the 27th of August. And I was actually thinking of doing this on TLX, but then I realized that TLX only released the half-year results. So they won't release their annual report for another 6 months or so. And I thought, yeah, I won't do it on TLX because technically it's not an annual report, only half-year report. So I thought instead I'll do it on one of the most recent released annual reports, and that is from a company called Stealth Group, which is actually a company I do own. And I have not gone through the annual report just yet. So you'll see what I sometimes do, quite often do, particularly for companies I own. Now, I don't do this or go through this process for every single company on the ASX. And I will go into a little more depth than I usually do. So let's get into looking at Stealth Group's annual report for financial year 2025. Okay, so this is Stealth Group's annual report 2025, released at about 10 a.m., so about 1 hour ago from when I recorded this video. Yeah, 9:57 a.m. It was or has been received quite goodly from the market. Share price up 6.15%. A little bit surprising because the share price or the chart, share price, I suppose you could say, was under a little bit of pressure. Well, I won't really focus on the chart, but I'll do it at the start of the video. And so typically when I see the share price under attack over the medium term, just before a company releases results, I'm just a little bit of a cynic and I think, okay, the results might disappoint the market, but we have not seen that with Stealth Group. In fact, you could even argue this could be a little bit of a breakout. The share price was in a bit of a downtrend, and the share price popped up above that downtrend line. So potential good results for Stealth Group. Okay, so this is a company, but by the way, this is TLX. So I was going through their Appendix 14 and I realized, wait there, this is on half-year results, not full-year results. Okay, so an Australian multi-sector distribution company. Now, the first thing I always do is I actually have a look at the results or the financial statements. I don't care about all the stuff before that. Well, I do care, but it's not initially what I'm wanting to look at first. So this is what I look at first, financial statements. And typically it's found, particularly in the annual reports, quite a bit down in the article, or the statement. So you always see the director remuneration, and then you get into the results. And before the director remuneration, you might have a lot of commentary, that sort of thing. And a lot of times I don't go through the commentary at all. Okay, so let's have a look at how this company performed. Now, first thing you should know about Stealth Group, they sell a lot of stuff. So what do we call them? A distributor, manufacturer of stuff, lots and lots of stuff, different stuff. Anyway, in fact, we'll have a look. You actually see in their activity section, they do have a bit of a principal activity section within the annual report, and hopefully we'll be able to see that later in the video. Okay, as I go up a bit. Okay, so the first thing I always look at is revenue growth. Is the company growing their revenue? And Stealth Group has no problems doing that. Now, revenue up from 113.7 million to 141.7 million, so nice growth in revenue. Now, this company doesn't have high gross margins, as you would expect for a company that distributes and sells stuff. So gross profit of only 40.7 million. So the other thing I'd probably pay attention to, and it won't be in Fiscal AI just yet, but a lot of times I'll take a few days before I have a look at Fiscal AI. And sometimes that means I'll take a few days before I have a look at the annual report and the results, because I do want to have a look at gross profit margins. You could do the calculations yourself, but I'm a little bit lazy because I don't have the margins here. Now, sometimes in the presentation, they might have that. In fact, let's open it up. Even the the media release, they might have gross profit margins in this. So sometimes they will provide that sort of information. Now, straight away, we can see they provided EBITDA margins, not gross profit margins. In the presentation, let's see if they've done that. And I do quite often look, and sometimes only look at a presentation. And that's just me being a little bit lazy. And I'm not seeing any gross profit margins. No. Here we go, gross margins, there it is. So down the bottom, gross margins at 28.7%. So a little bit lower than what they saw last year. So that could be a little bit of concern at this point in time, and not for me just yet. But if we see gross margins continually dropping over time, that would be a little bit of concern. I might just keep that up. Okay, I won't keep up the media release. Anyway, so that's some of the first things I look at. Also look at the expenses. Have they significantly increased expenses like Telix Pharmaceuticals did? They significantly increased expenses, but that was not a red flag for me because they are spending more and more to grow even more significantly in the future. Now, any red flags here when it comes to Stealth Group? Not really. Personnel expenses haven't increased all that much. So maybe the company is moving towards scale. So that means they can increase their revenue without significantly increasing their spending like personnel expenses. So maybe this is not a labor-intensive company. Wouldn't be that? Yeah, it wouldn't be that intensive. If you compare the personal expenses to revenue, it's not that big of a. Yeah, it's not that big. Anything else of note here? No. In fact, you could definitely say that the revenue and gross profits increase at a greater rate than their expenses. And that can be shown when you have a look at profit from continuing operations before income tax. It more than doubled. Revenue didn't more than doubled, but their profit actually more than doubled. Profit after tax went from 1.4 million to 3.1 million. And you can just see the very low margins this company exists on. Profit of $3 million on revenue of 141.7 million. In fact, if you have a look at Pro Medicus, let's do that. Let's just compare. This is me being really mean towards Stealth Group, comparing them to Pro Medicus, but there is a reason I'm doing this. Let's have a look at Pro Medicus's. Now, I can't do this video on Pro Medicus because I've already done a standalone video on this company and their financial results. But if you have a look at this company's, if I could find it, oh, here we go. If you have a look at this company, a revenue of 213 million, so it's a little bit more than the Stealth Group, but it's not significantly more. 141 compared to 212. But Pro Medicus profit is 115 million. And you just see the massive margins that Pro Medicus has, and that is why this is a beloved company. Anyway, so margins do matter, and these sort of companies tend to not have high margins. Now, if they did, you could see, and you would see, massive amount of competition come in. That's the reason why there's not much of a moat for these type of companies. Not much at all. In fact, you could even argue that management is way more important for these type of companies than, say, Pro Medicus. That's an interesting argument. Because if the company doesn't have a moat, it really is up to management to really grow that company, to expand that company. Okay, earnings per share, 2.63 cents, which I suppose is important if you really look at the PE ratio. By the way, share price of this company is at, what was it, 63 cents or something? 69 cents. So you wouldn't say that's cheap. We're talking about PE ratio of 25, 52, 52, above about 26, 27. So just based off that, you might say, oh, that's quite expensive, but profit more than doubled. So if you say and assume that profit can double again in 2026, yeah, P ratio of 26, 27 is quite small. Now, I'm not saying the company will double their profit, but I'm just saying it's on a low base. Okay, what else do we have here? Okay, balance sheet. Love the balance sheet. Love the balance sheet. I'll actually decrease the font. There we go. Love the balance sheet. Funny enough, the first thing I always look at is total equity. Okay, so equity rose 50%, went from 20.4 million to 30.2 million. And you definitely want to see, in my opinion, you definitely want to see equity increasing. So equity is just, if you take the total assets and subtract the total liabilities, that is equity. So you want the assets increasing at a faster rate than liabilities. Now, one of the ways you can increase equity, by the way, is increase profits. So profits going up. That would be good. But another way you can increase equity is by borrowing and share raising. So anyway, this is a whole different story. Okay, so some things I look for here are inventories. Now, like for instance, in this sort of company, you might want to see and make sure inventories haven't expanded significantly or decreased significantly. That could be another big red flag if you see inventories just drop like a rock. And sometimes if you do see inventories rising significantly, that can have a negative impact on cash flow because they're building up inventory. And to build up inventory, you need to spend some money. Now, another thing I'll mention here is I will have a very quick look at some of the working capital changes, and that includes receivables, inventories, and payables. And I'm just looking for any significant changes. And there's not from last year. In fact, they're all steady from last year, which is incredible. You typically don't see that. Other things I look for here, I'll have a quick look at intangible assets, but I have a look at any sort of debt, like borrowings. Now, this company has lease liabilities. Now, I don't ignore lease liabilities, but I don't pay particular attention to it. But I will have a look at financial liabilities. Now, it doesn't say loans, but I'm assuming financial liabilities in current and non-current loans. And they are both at about combined about 23 million. Now, if you don't know, you should have a look at the notes. So C11. So let's have a quick look at C11. And I wonder if most investors don't have a look at notes. Now, you have to find it. C11, I'm in F's. Here we go, C11, financial liabilities. And this is borrowings, borrowings. CBA facility, 21.2 million, and insurance premium funding as well. And you could have a look at the particulars of the funding facilities. For instance, there's heaps here written about it. I won't go to too much depth, but pay attention to the notes. I do like notes. And in fact, my favorite note, I'll show you in a second. Okay, back to the balance sheet. Okay, so no significant red flags when it comes to the balance sheet. You could say this is a healthy balance sheet. It's a nice balance sheet. I don't know. It's up to you to decide what is the definition of a healthy balance sheet. I don't really look at changes in equity, I'll be honest with you, but I do have a look at cash flow statement. And I just want to compare how the company is generating cash flow versus profit. And in fact, we can do that through note C2, which is my favorite note, reconciliation of the profit to operating cash flow. Now, for instance, this company had a profit of $3 million, but operating cash flow of 4.9. Funny enough, last year they had an operating cash flow of 6.3. So the question becomes, why did it drop? Is it significant? The company is also free cash flow positive by a fair bit. We're talking about $3.9 million. They paid for intangible assets. Sometimes I have no idea what that is, but they are generating a bit of cash flow. Not overall cash flow, because that payment for intangible assets was 3.8 million, which is significant. Maybe that was an acquisition. I'm trying to remember if they made an acquisition. Yeah, it could have been an acquisition, that sort of thing. And they actually did do a capital raising, $7.5 million, and more than likely that was for an acquisition. Now, at the end of the year, they had $14.4 million of cash. 14.4 million of cash. So let's go to my favorite note, C2, and this is the reconciliation. Well, it should be. Oh, I've gone way past it again. C2. No, I've gone past it again. Okay, here it is. Reconciliation of cash flows used in operating activities. And the reason I like this is you can see how you get from a profit to an operating cash flow. So that means changes in working capital, depreciation, amortization, what has led to the change. And sometimes you'll see a massive change or massive difference between the two. Sometimes you see profit significantly higher than operating cash flow and vice versa. And it's just good to know why. Maybe it's just me. I don't know. It's good to know why. And a lot of times it's just changes in working capital. Receivables, inventories, and payables are the main three. And for this company, for instance, increase in trade and other receivables, 1.9 million. And they do have a negative here, which is important. So that will have positive effect. I forget, positive or negative. Anyway, and there was an increase in inventories by $2 million, which is interesting because I didn't think it would change all that much. And both of those will be a drag on the cash flow. Because you think if you're spending more money on inventories, it's because of cash. You're decreasing the cash flow. And the same can be said for receivables. If receivables have increased, there's more money waiting to come in. So you could be receiving that cash very quickly after the start of the financial year. So when you see those two numbers go up a fair bit, or in this case, they're up, even though there's a negative sign there, that is a bit of a drag on the cash flow. And the same is true for payables, but in the opposite direction, and there was very little change for payables. So that means there was a pretty big change in working capital, and the cash flow of this company could have been significantly better. And that's why operating cash flow was quite high. No, wait there. It could have been higher than 4.9 million. Yeah, it could have been higher than 4.9 million. Now, why was it 1.8 million higher than the profit? Depreciation of right of use assets, so leases. I'm assuming that is leases. Also a bit of amortization, depreciation, interest expense, right of use liabilities, that sort of thing. Also increase or decrease in deferred tax assets and stuff like that. Now, I typically pay more attention to changes in working capital and depreciation amortization, but you get a good sense of why there's a difference between profit and operating cash flow, and things are still moving in the right direction. Now, if you compare this to last year, this is very important. You can see last year, and the reason why they had higher operating cash flow than this year is really because of a decrease in trade and other receivables, $3.8 million decrease. And that is why there was really good operating cash flow last year and not as good as this year. So I would never have a look at just operating cash flow of a company and use that to judge how a company performed, because it's contextual. It's all contextual. There's context or that sort of thing. Okay, so another thing I always do is, where is notes? I go through the notes. Now, there are some very important things in the notes, basis of preparation. I suppose you could go through that if you really, really wanted. Typically, they have, sometimes they have ongoing concern or going concern somewhere here. Not always, but somewhere in here they might have that. Here we go. This is another section I like. Particularly if a company has a lot of different sections, divisions, segments, they actually break it down. They explain the breakdown. For instance, the board of directors' view is that there were two reportable segments during the current reporting period, being the operations of industrial services, industrial and consumer technology, which I believe they did acquire a few years ago. These are different to reportable segments as reported as financial year 24, post the group's acquisition of Force, which is consumer technology. So the reason I like this is you can see how different divisions or segments are performing. For instance, let's have a look right now. So industrial, $103 million of revenue, consumer $38 million, and then they break it down into profit. Sometimes you even see margins. They haven't done that here, which is okay, I suppose, but it gives you a good indication of how a company is performing. Now, in their presentation, more than likely, they have done that for you. Wait there, what am I? Oh, that's Pro Medicus. I was going to say, why do I have two annual reports up there? Anyway, so sometimes in their presentation, they will break it down into nice pictures and nice little tables. In fact, here it is. So they've got the two divisions here: industrial distribution, consumer products, financial performance, 5-year review. I really like when a company produces or shows you a 5-year overview. Division sales performance, here we go. So you can actually see this typically in the presentation, but sometimes you don't get in the presentation. This is where you find that sort of information. What else can we see here? Sometimes what you see is a breakdown of revenue by geographic region. I don't think you're going to see that with Stealth, because I don't think they have much of a geographic diversity, or they don't have much geographic diversity, but sometimes you will see that in a company. What else do I look at? We have the reconciliation. You could have a look at the debt. There it is. Any sort of impairments. So some of these I don't look at all. Like property, plant, equipment, I don't really care all that much. Intangible assets, if you like confused about intangible assets, you can actually have a look at this section. And the reason it looks like it did increase was because of the acquisition of Force Technology. So that is, when you acquire a company, there is a bit of intangibles attached to that, like name, like brand. Like if you bought Coca-Cola, you're going to pay way more than it's actually really worth because of brand. And in fact, well, yeah, I'm probably not saying the right thing, because the brand is actually worth something. Impairment, goodwill, trade other payables. So a lot of this I won't go through all that much. Right of use assets, I'm assuming this is leases. Yep, leases. A right of use asset is recognised at the commencement date of a lease. You can go through that if you want. Taxation, don't care. Capital structure. This is where it can get interesting, because you can see how many shares are issued. Here it is. Shares in issue. Shares in issue in 2024, 2025, how much it's increased, why it's increased. You can see performance rights, dividend reinvestment plan, performance rights, capital raising, performance rights, forced acquisition. So we can definitely see how the shares have increased over the past year or so, and that can be important. But 129.5 million shares on issue. So times that by the share price, and you get the market cap of the company. Any sort of share-based payments reserve, whatever that is, dividends, how much money, although you can get this from the financial statements, and earnings per share, here we go. So using weighted average number of shares, $118.6 million, profit years, earnings per share, 2.63 cents. You can see how they calculated that. Okay, what else? Going through this fairly quickly. Controlled entities, sometimes a company might have all these different subsidiaries or stuff, and you can see that here, like Australian Workplace Services, Heatley's Group, Heatley Sales, Industrial Supply, Trade Counter, etc., etc. There's Force Technology, 100% owned. And according to this, BSA Brands, they own 0%. Okay, what else? Business combinations, deed of cross guarantees. Some of this I don't look at all. Risk management. Something else you might want to look at, key management personnel disclosures. No, I don't care about that. Accounting policies. I'm just going to see if there's, well, not if, there should be some sort of, what do you call it? Auditor statement somewhere here. Director's declaration. Here it is. Auditor's independence declaration. And there shouldn't be anything of note here. There shouldn't be anything of note. On occasion, you do see something interesting in an auditor's report, but I find that to be quite rare. And sometimes they do have a going on concern statement. Haven't seen that yet in this. Major shareholders as well. Sometimes you'll see this in the report if you really, really care. And that might be it for that part. Now, I'm not usually that obsessive. I wouldn't say obsessive, but I don't not usually that in depth when it comes to annual report. I don't go through every single thing. I know what I'm looking for typically. Now, this is what you might want to look at if you want to know the company a little bit better. So go through the start of the annual report. They talk about their business model, have the two different sections here, what they do, etc., etc., etc. If you care about sustainability, you might want to read this. I don't. Well, I do care, but I don't really care. Talking about their businesses, locations, consumer products with that acquisition of Force, on and on. Sometimes, I'm not sure how long this is going. Chairman's message, never read that. Brands added to our portfolio in financial year 25. Yep, I know most of that. You might want to learn about the leadership team, and you can learn about it. But a lot of times I just go to the website if I wanted to know about the leaders, the managers, and the board, because usually they have a lot of information on the website. And then you have a look at the business review, bit of commentary, how the company's growing. But a lot of this information should be seen or found in the presentation. Oh, they do have a return on capital employed, which is interesting. Nice at 16.7. That's nice. Training results. And I'm trying to get to the what do you call it? The director remuneration. Director's report. Okay, so this is probably the most boring part of the annual report. Talking about what the directors did, like how many meetings they attended to. And here we have the principal activity. Funny enough, this is, I didn't know that, Simon Poitevin. That name is familiar. Sometimes you have the principal activity in this section, which is interesting, and just tells you what they do. So, I mean, I'm not sure why they put it there, because at this point, everyone should know what they do, because if you're delving this deep into an annual report, by this stage, you already know what they do. Now, I do know quite a few people do like to have a look at the remuneration report just to see, like long-term incentives, short-term incentives, that sort of thing. And sometimes I will have a look at it. But this is, I'll probably say it's, how important is it? What's that saying? Show me the incentive and I'll show you the outcome. So in a way, incentives are quite important. And yeah, that's all I'm going to say. Show me the incentive and I'll show you the outcome. But there's a lot of information here. So I'll leave that to you if you really want to delve into these sort of things. Okay, that is typically what I do when it comes to annual report. Way more in depth than what I usually do. Typically I just look at the financial statements and then I go to the presentation. I might have a look at the media release, and sometimes it can be as quick as a few minutes before I move on to the next one. Okay, that is all I have. If you have any questions, any thoughts, leave those in the comment section of this video. Otherwise, I'm not a financial advisor. If you need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.